We're going to continue talking about our key financial statements. The first one we talked about was the balance sheet, and part of that is assets equals liabilities plus owner's equity. You got to say it with that deep voice because that's the fundamental accounting equation. Now we're going to talk about the next major statement, that thing we call the income statement. This is a big deal because the balance sheet is a snapshot of a picture in time. The income statement is a movie because it keeps on moving along and you have to watch it as it goes and develops in the process. Pretty much, it's pretty straightforward. Revenue minus your expenses by the time you're all done, and hopefully you'll have a net income and not a net loss. So let's dive into it. Here is the formula. It looks kind of complex in this up and down picture of it. Revenue minus cost of goods sold. You know, how much you paid for the goods. That'll equal your gross profit. From your gross profit, you take all your operating expenses you have, and then that's going to be your net income before taxes. You take away your taxes, and then hopefully you'll have net income, or if not, you'll have a loss. So you pay attention to the whole aspect of some of the components. Cost of goods sold is the cost of merchandise sold or the cost of raw materials or supplies used for producing items for sale. And then from that, you have your revenue. Revenue is all the money that your company brings in. So whatever you have, all that money it comes in from your, whatever service you're just selling or good you're selling, whatever it is, that's your revenue. From your revenue, you take the cost of the goods sold, the ones you manufactured. How much did it cost you to have that item to sell? And then from that, you have gross profit. Now, from the gross profit, you're going to sit down and take your operating expenses. That's involved such as rent, utilities, and salaries. And then from that, you're going to take away things like depreciation. And depreciation is the write-off of a tangible asset over its useful life. A lot of times, let's say a car. A car is used to deliver goods. So you have 7 years that you keep the car around, and you write off 1/7 of it each year if you're using what we call straight line depreciation. So you write off part of it each year. Now, let me back up over here. The ins and outs of inventory, you have to know what this is because that's part of the whole aspect of it. We normally use a thing called FIFO, first in, first out. You see this when you walk into the grocery store. Of course, the grocery store, they hide the milk in the very back of the store. So you have to walk through a zillion different things, especially all the food that's bad for you. You have to walk past it and look at it and drool and everything else. Then you finally get to the milk. So in the milk, what they do is they have it all sliding forward. Miraculously, the first one they have is the one they want you to buy. So it's at the very front, and you have to struggle to pull it out, and certainly can't try to reach behind it because they have this big case. Well, they're smart because they want the first one that they receive to be the first one out the door. But your mom taught you better. Your mom says, listen, whenever you go in that store, you need to go out and find the one with the best date for you. And sometimes that means digging. So you have to dig way back and you grab the one, and the one that is a little bit newer than the one at the very front. We call that LIFO, last in, first out. But really, a lot of times you deal with the first in, first out. And that's pretty much a standard way that you count your inventory as well. Last in, first out, there's a few items in the world that it really doesn't matter. One famous example is called the Anaconda Mining Company, which mined copper in the northern part of the United States. Anaconda had been building up piles of copper ore. You know, copper ore, it doesn't matter when you put it up there or when you take it away because it's already millions of years old anyway. So what difference does it make? So with that, they said they've been mining. They started mining a pile of a copper ore back in the 1930s. And all of a sudden, 60 years later, they went on strike. They went on strike. They had this huge, gigantic mountain, hundreds of feet tall, and it actually extended for a couple of miles, literally. So you're talking about 15,000 feet, almost 3 miles of a giant heap of copper ore. Well, they started using it up so the people went on strike saying, we want more money, we want more money. So they put the most recent stuff on top. They lose last and first out. By the time they were all done, they started scraping the top and then they went down lower. As they went down lower, they started calculating the cost of the goods, and the cost of goods sold were now cheaper. Well, as the strike continued, they went deeper and deeper into this gigantic pile, and they kept on selling more and more. They weren't mining anything more because the miners were on strike. So now all of a sudden they're finding a copper ore that's valued at half of today's price, and they're selling it. They're making massive profits. The miners say, "You told us you're not making any money, but we really aren't making any money because this is the old ore. Old ore, now you're making money." So the strike went on for 3 years, and they kept on scraping that pile down, down. And of course, by the time they got down to the copper ore that they scraped in 60 years before, all of a sudden it's dirt cheap, a fraction of today's cost. They're making huge profits. The strike ended, and 6 months later, Anaconda Mining went away because they used a last in, first out inventory system. And of course, it didn't matter except for the fact they had a massive profits the last year, and then they had to pay so much in wages they couldn't keep up. They closed their doors. That's why you don't use last in and first out. First in, first out. That way you can keep track of your inventory. And of course, revenues minus your expenses, then rent and everything else, and then you write off the cost of your tangible assets over a period of time. That's another expense. And by the time you have all your operating expenses, you have your gross profit. And then you're going to look at your sales returns and the bottom line, take off your taxes, and then you have your net profit, hopefully, or your net loss. Lonnie here. He has a gas station. He wanted to have healthy organic food. Lonnie makes a lot of money. He makes $11 million gross food. But Lonnie, he says he's an organic food guy, healthy food. Take a look. He's got Cheez-Its on those racks, and he's got candy that you and I like to eat. We know it's bad for us, and Lonnie's selling it to us. Lonnie, you got to watch it. He sure is a sharp businessman, though. No matter what happens, he took out a loan of $875,000 and leveraged into this gigantic business that brings in $11 million annually. It's phenomenal. We talked about two statements: the balance sheet with the fundamental accounting equation, and then your income statement, which really revenue, you take out all your expenses, you take out your operating expenses, you take out all the different aspects, your cost of goods sold, you take out your taxes, and then what you end up with a net profit or a net loss. Now you have really the statement of cash flows. This is a big deal. It's a much bigger deal for the small business person on the corner than it is for General Motors. General Motors has been around 100 years, and they're huge, gigantic. So if the cash flow is not a big deal that year, it's not going to hurt them financially. Or the cash burn, how much you go through money, cash, we call it the cash burn, happens. You need to know your cash flow. There's a difference between cash coming in and cash going out. And sometimes you have to manipulate it so you have some money in case something comes up. It's a big deal. So cash flow management is a big deal. Take, for instance, a ski resort. A ski resort hardly makes any money in the summertime because they make their money by having people coming in and guess what? Ski. You have to have snow to ski. Okay, so with that, they only make the massive amount of revenue a few months out of the year. So you have to really watch your cash flow management. Same thing with the golf course, except the other side, they make money when the grass is green, not when there's snow on top of it. So you look at the whole aspect of the company financial statements, you got to be careful. You need to follow the rules that are out there, especially the Financial Accounting Standards Board that laid it out. You accept a job offer, make sure you're honest and whole profit, because that too can sit down and be a huge issue. So pay attention to your accounting process, and everything should be paying attention to the aspect of your cash flow, your income statement, and your balance sheet. These are the three most critical items that you need to take care of in your process of watching your company's financial statements. Take care.